Welcome to Iraqi Dinar News, where you receive real and authentic updates about the Iraqi dinar. If you want to stay informed with moment-by-moment developments, make sure to subscribe to the channel and like the video. Today we are analyzing an important claim that has been circulating regarding the historical value of the Iraqi dinar and the role of sanctions. The argument suggests that US sanctions in 2003 brought the value of the dinar down, and that if remaining sanctions, specifically those administered by the U.S. Treasury's Office of Foreign Assets Control, or OFA, were removed, the dinar could automatically return to levels above $3, even specifically around $3.22. This is a serious economic claim, and it deserves a careful, fact-based breakdown. To understand the current discussion, we must retrace Iraq's monetary history. Prior to 2003, Iraq operated under heavy international sanctions following the Gulf War. During the 1990s, comprehensive United Nations sanctions significantly restricted Iraq's oil exports, foreign reserves access, international banking connections, and overall participation in the global financial system. Over time, the Iraqi dinar lost purchasing power domestically and internationally. Exchange rates diverged between the official rate and the street rate, and confidence in the currency deteriorated. However, it is essential to clarify a common misunderstanding. The pre-2003 official rate of over $3 per dinar was largely an administratively set rate under a closed, state-controlled economy. It did not reflect a freely traded, market-based exchange rate backed by transparent foreign reserves and open capital markets. Iraq's currency was not fully convertible on global markets in the way major currencies are today. Therefore, comparing that era's official exchange rate to today's market-based framework requires caution. After 2003, Iraq underwent a full monetary restructuring. The Central Bank of Iraq, known as the CBI, introduced new banknotes and moved toward a managed float system, anchored by foreign exchange auctions. The country rebuilt its foreign reserves primarily through oil exports, which remain Iraq's dominant source of revenue. Over the years, the dinar has traded in a range around 170 to 460 IQD per US dollar, depending on policy adjustments and market pressures. Now let's address the sanctions question directly. The claim we're examining suggests that US sanctions automatically drove the dinar's value down, and that removing remaining sanctions, particularly OFAC-related measures, would automatically restore it to previous levels above 3. This is where economic analysis becomes critical. Sanctions absolutely impact an economy. They can restrict access to foreign capital, limit dollar transactions, reduce investor confidence, complicate trade flows, and increase transaction costs. In Iraq's case, sanctions historically affected oil exports, banking access, and financial integration. These pressures contributed to inflation, currency weakness, and economic contraction. However, exchange rates are determined by multiple variables, not a single factor. These variables include foreign reserves, monetary policy, inflation rates, productivity, GDP growth, balance of payment stability, fiscal discipline, political stability, and overall market confidence. Sanctions are one component within that broader macroeconomic framework. Today, the only remaining US sanctions applicable to Iraq are primarily targeted compliance measures administered under OFAC regulations. These are not comprehensive country-wide trade embargoes like those imposed in the 1990s. Instead, they focus on specific individuals, entities, financial channels, and anti-money laundering compliance structures. In recent years, the U.S. Treasury has tightened dollar access for certain Iraqi banks to enforce transparency and prevent illicit dollar outflows. It is important to understand that these measures are not blanket prohibitions on Iraq's oil exports or global trade. Iraq continues to sell oil internationally. It continues to receive oil revenues. It maintains foreign currency reserves that have at times exceeded or 100 billion. The Iraqi government participates in international institutions such as the IMF and World Bank. The country is not economically isolated in the same way it was during the 1990s sanctions regime. Therefore, the assumption that removing remaining OFAC compliance restrictions would automatically restore the dinar to 3.22 oversimplifies the situation. Let's analyze why. First, exchange rate levels are anchored to economic fundamentals. Iraq's economy today is oil dependent, with limited diversification. Non-oil exports remain modest. The private sector is still developing. Infrastructure rebuilding continues. Public sector wages represent a large share of government spending. These structural realities influence the sustainable value of the currency. Second, money supply matters. The volume of dinar in circulation today is dramatically higher than it was decades ago. Currency valuation is not simply about past exchange rates. It is about the ratio between money supply and foreign reserves. If a country were to suddenly revalue its currency from roughly 300 dinars per dollar to 1 dinar equal to 3, that would represent an extraordinary appreciation requiring massive reserve backing and a complete monetary structuring. Such a move would have significant consequences for exports, fiscal balances, and domestic price competitiveness. Iraq's budget is calculated in dinars, but funded largely by oil revenues priced in dollars. A dramatic overnight revaluation would change revenue conversions, potentially creating fiscal distortions unless carefully managed. Third, we must separate the concept of sanctions removal from currency regime decisions. Even if all compliance-related restrictions were lifted tomorrow, the Central Bank of Iraq would still determine exchange rate policy based on macroeconomic stability. Central banks typically move cautiously. They prioritize price stability, inflation control, and financial system confidence. Large sudden currency revaluations are rare in modern emerging market economies, unless part of a redenomination or structural reform program. Now, does that mean sanctions are irrelevant? Absolutely not. Reducing compliance friction in dollar transfers can improve liquidity conditions. It can narrow the gap between official and parallel market rates. It can increase confidence among international investors. It can improve banking sector efficiency. All of these factors can support currency stability and possibly gradual appreciation over time. But gradual strengthening is very different from an automatic reinstatement to a pre-2003 administratively set rate. It is also important to clarify what reinstatement means in monetary terms. In modern central banking, currencies are not restored to historical pegs based on legacy numbers. Exchange rate policy reflects current economic realities. Iraq's economic size, productivity base, inflation profile and fiscal structure today differ significantly from those of the early 1980s or early 1990s. In the short term, if compliance frameworks improve and Iraq strengthens anti-money laundering systems, we could see continued stabilization of the exchange rate. The spread between the official rate and the parallel market rate could narrow further. That would be a positive development for consumers and importers. It would reduce inflationary pressure caused by exchange rate volatility. In the medium to long term, sustainable appreciation would require deeper structural reforms. These include diversifying the economy beyond oil, strengthening private sector growth, increasing foreign direct investment, improving governance transparency, modernizing the banking sector, and maintaining disciplined fiscal policy. If those reforms progress consistently over years, currency strength can follow gradually. For IQD followers, the key takeaway is this: currency valuation is not a switch that flips automatically when a single policy variable changes. It is the result of complex economic alignment. The idea that removing OFAC sanctions would instantly place the dinar at 3.22 assumes a direct one-to-one cause and effect relationship. In reality, exchange rates reflect supply and demand dynamics in domestic and international markets. They reflect confidence, liquidity, trade flows, and capital movement. Even fully open economies with no sanctions experience currency fluctuations based on economic data. Another important consideration is inflation differentials. Over the past 2 decades, the US dollar has experienced cumulative inflation. Iraq has experienced inflation cycles as well. Real exchange rates adjust based on relative price levels between countries. A nominal historical figure does not automatically translate into present-day equivalent purchasing power. Additionally, central banks must consider competitiveness. If a currency appreciates too quickly or too strongly, exports can become less competitive. For Iraq, oil exports are priced in dollars, so direct competitiveness effects are limited there. However, a dramatic appreciation would impact domestic production costs, imports, and fiscal conversions in complex ways. From an investor perspective, responsible analysis means focusing on verified economic reforms rather than hypothetical automatic reinstatements. The Central Bank of Iraq has emphasized stability in recent communications. Stability is often prioritized over dramatic shifts. Now let's consider the broader geopolitical context. Improved financial compliance between Iraq and the United States can strengthen banking relationships. It can attract international partnerships. It can support integration into global payment systems. These are constructive developments that improve economic resilience. Over time, stronger institutions tend to support stronger currencies. But that process unfolds gradually. For viewers following Iraqi dinar developments, it is important to monitor concrete indicators: foreign reserve levels, fiscal budget balance, oil revenue trends, inflation rates, banking reform progress, IMF consultations, and exchange rate policy statements from the Central Bank of Iraq. These indicators provide measurable evidence of currency direction. In the near term, we should expect continued focus on exchange rate stability rather than dramatic revaluation events. The CBI has shown preference for managed adjustments rather than shock moves. Policymakers typically avoid abrupt currency changes that could destabilize markets. In conclusion, sanctions historically contributed to economic weakness in Iraq, but they were one of several factors. Today's remaining OFAC compliance measures are targeted and do not represent a comprehensive embargo. Removing them could improve liquidity and confidence, but it would not automatically reset the dinar to historical administrative levels above $3. Sustainable currency strength depends on economic fundamentals, structural reform, fiscal discipline, reserve adequacy, and long-term institutional credibility. That is the responsible and evidence-based framework through which to analyze Iraqi dinar developments. If you value factual, balanced, and responsible coverage of Iraqi dinar news, make sure to subscribe to the channel and like the video so you never miss an update. And as always, this content is provided for informational purposes only and does not constitute financial advice.